Hello, everyone. Welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Bassett Furnature Industries Incorporated, ticker BSET. And this one is giving me very similar vibes to Legged and Platt, which we looked at a few months back. And I rated that one a sell. It just seems like the furniture market or parts market is going through some tough times, and now might not be a very good time to hold stocks like this. But we'll run through the numbers here and see what's going on. Clearly, the stock is undervalued, but there are other things that we need to look at too. And maybe we do a head-to-head between this and Leggett and Platt to see if you were to get a furniture stock, which one would be the better buy. We'll start off with the revenues. Everything orange here is important, and we see that they're coming in or expected to come in this year lowest that we see in the time frame aside from 2020. So that's what's really standing out to me. And if we go look at the graph, you can see that revenues are incredibly flat. And this year is the second lowest after 2020. They're not doing a whole lot to raise those revenues, which is not something that we really like to see in stocks. Their gross profit is on a bit of a dip. It's climbing back up now, and the EBIT slightly climbing year over year. Net profit was negative in 2020, but that has been on a good uptrend since then. So, although the revenue is not great, they have been better about shoring up their operations come 2021 and 2022. Back to the metrics, we now look at expenses as a portion of revenue. We want to see this on the decline, and we could say that it is. It was about 100% in 2020, hanging out around that point in 2019, and it was down to 93.8 last year, 94.7 the year before that. So we are seeing a bit of a downtrend there, which is good to see. Their expenses are very high, so we'd want to see that continue for quite a while longer, especially at this rate. Earnings per share, last year they came in at $6.96. They did have two negatives back in 2019 and 2020. Came through with $1.83 in 2021, and this year they're expected to do $1. From what I've seen so far, they've done 30 cents, so they do have to pick it up to finish off the year at $1, and next year they're expected to do $1.82. So that gives an earnings yield of 6.6%, which is not bad. We are looking for something of at least 5%. It looks like they had some really good numbers 2021 and 2022 off those higher earnings. And the share price has kind of stuck around this level for a bit. It looks like in 2020, it kind of peaked. $20.08 is how it finished out that year. And aside from that, it's been in the $15, $16, $17 range. So not a whole lot of movement there, all within 10 to 20% of each other. Share count, we do want to see them buying back shares, and that seems to be exactly what they're doing. 10.3 this year, they're expected to bring it down to 9.1. So that is a pretty nice trend. Free cash flows, we want to see those growing and to have a good yield. They came in negative this last year, and their yield, when they are positive, is not the best. So that's another red flag, bad sign for the company. Tangible book value is positive. They do have a lot of assets and a lot of liabilities, but the assets far outpace the liabilities, and they come up with a debt to equity ratio of 1.08. They had peaked up to 1.55 in 2020, and looks like they've gotten that down a third since then. So they are on a pretty good trend, which means I'd expect in the next year or two this to be under 1 like we look for on the debt to equity ratio. They are pretty good about raising their dividend, and we can see that here. It did take a bit of a dip in 2020, and then they've been raising it very nicely since then. And we see that they've been raising it about 6% per year, more recently 14.8%. The currently yields 4.7%, which is a very good yield. So it looks like it might be more of a dividend stock than anything else. and that dividend's bringing in a decent amount of value. It is above the current share price. And then for ROE, we are looking for something above 20. Of course, it was negative for the 2 years where they had negative net profits, but last year they came in at 33.4. This year, off expectations, they'll come in at 7.2. So, not quite in line with what we like to see. And that is what we're looking at here. So, revenue, kind of yellow flag. They're growing it a bit too slow, very range bound, very flat. Expenses as a portion of revenue on a decent trend, but definitely needs to continue. Earnings per share, do not like the negatives within the last couple of years. Inconsistencies next year. It looks like they're expected to come in right about what they came in at 2021, but with lower revenues. So it shows that they have been shoring up their business and their financials. Share count is on a very nice trend. In fact, they've been buying it back 3% a year. Free cash flow yield, not good, very low. Definitely a red flag there on free cash flows. Tangible book value looks good. Debt to equity looks like it's at least trending in the right direction. So that's yellow. ROE, red. So definitely mixed on this stock, uh, leaning towards more of a hold. I don't know if it's necessarily a sell. I mean, we see some decent asset growth, positive tangible book value. Liabilities are shrinking. And then when we get to the prices, we see that it's pretty consistent on the price. The price does not move a whole lot. The balance sheet continues to grow. Cash flows are all over the place, and everything else is kind of straight down the middle. So it doesn't look like it's really too far undervalued at this point. If we look at the metrics, it looks a whole lot more. We'd be looking at the end of last year, 55 for the fair value. This year, 36, which would give our margin of safety around 30 and a half. And it definitely trades for a premium. I mean, we see huge premiums over the last 3 years. Back in 2020, it was trading for over the fair value, but it is definitely not doing that anymore. So it could be that the market has not discovered the stock yet, or it could be that the stock is discounting it because of the lack of revenue growth and inconsistencies. I know that I definitely would. I don't know how much I would discount it. There is at least growth year over year in these metrics, mostly coming from the balance sheet. But I definitely would not be looking at buying this at anything $20 or above. So that's what we're looking at here. I definitely think that I should do a head-to-head between this and Leggett and Platt and see which one of the two is a better buy. Because I used to own Leggett and Platt. I made a good profit on it, but after I analyzed it, I did not think that there was good reason to stay in the stock and sold out, and it's down more than 10% since then. So I'm glad that I did. Thank you guys for watching this one. Please like if you enjoyed the video, comment if there's any other stocks that we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.